Why do you always buy right before the drop and sell right before the rally? It's not bad luck. It's not your indicators failing. It's because you're dancing to a rhythm you can't hear. A rhythm that Wall Street insiders have been using for 100 years to transfer your money into their accounts. But here's the twist. A 15-year-old boy cracked their code in 1888. No college degree, no connections. Just raw hunger to understand why some people got rich while others lost everything in the exact same market. Fast forward 30 years, and that same boy becomes one of the most feared men on Wall Street. Not because he had insider information, not because he had more capital, but because he cracked a code that the richest players desperately wanted to keep secret. His name was Richard Wyckoff, and what he discovered changes everything. Here's what nobody tells you. Every single day, billions of dollars move from retail traders into institutional accounts. It's not random, it's a choreographed dance, and you've been watching it without knowing the steps existed. Welcome to Trading Psychology Stick. Quick disclaimer, this is purely educational. I'm not a financial advisor, and nothing here is investment advice. Always do your own research and manage your risk. This video will transform how you see every chart. You'll never look at volume the same way. You'll never see a trading range as sideways noise. And you'll start spotting smart money's footprints before they move. But here's my warning. Once you see what I'm about to show you, you can't unsee it. The market will look completely different. Are you ready? Chapter 1. The origin story and 3 fundamental laws. The greatest market methodologies weren't created in university classrooms. They were forged in the trenches by people who had everything to lose. Richard Wyckoff started as a stock runner at 15, sprinting through New York streets, delivering stock certificates between brokers. While other kids were in school, young Richard was absorbing Wall Street's rhythm, and he noticed something strange. The market moved in waves that seemed orchestrated, like someone behind the curtain was pulling strings. By his early 20s, he'd climb from runner to broker. He'd see a wealthy industrialist quietly buying railroad shares, while his newspaper ran articles about how railroads were dying. 6 months later, that stock would double, and the industrialist would sell to the excited public reading positive headlines. The pattern kept repeating: buy in silence, create the story, sell into excitement. This was psychological warfare. But in 1907, instead of just getting rich, he founded the Magazine of Wall Street. His mission wasn't to gatekeep the secrets, it was to expose them. Why? Because Wyckoff saw families destroyed, dreams crushed, all because of information asymmetry. He made it his life's work to level the playing field. His revolutionary idea was this: you don't need insider information if you can read the insider's footprints on the chart. Wyckoff studied under Jesse Livermore, J.P. Morgan, E.H. Harriman. He wasn't theorizing. He was learning from the people who move markets. From decades of experience, Wyckoff distilled everything down to 3 fundamental laws. The first law is supply and demand. Price doesn't move because of news or earnings. Price moves because the balance between buyers and sellers shifts. Everything else is just the story told afterward. Imagine an auction for a rare painting. When multiple people desperately want it, the price soars. When nobody wants it, the price drops. The painting didn't change, only demand shifted. Large institutional players understand this deeply. To accumulate a large position without driving price up, they need to do it when supply is plentiful and demand is weak. They absorb all the selling that retail traders are doing, quietly, patiently. This is why stocks make bottoms in the most pessimistic environments. Not because fundamentals improved, but because smart money finished accumulating. The second law is cause and effect. Before any significant move happens, there must be preparation. Wyckoff called this preparation cause. The effect is the subsequent price move. The amount of cause determines the extent of the effect. Picture a spring being compressed. The more you compress it, the further it launches. Trading ranges work the same way. When a stock trades sideways for weeks or months, it's building cause. The longer the consolidation, the larger the eventual move. Every big move you've seen was preceded by preparation. The market doesn't explode higher or crash lower randomly. It builds up energy first. The third law is effort versus result. Effort is volume, result is price movement. When you see massive volume but minimal price movement, something important is happening, either accumulation or distribution. Imagine pushing a car. If you're pushing hard, but the car barely moves, someone is pushing from the other side. In markets, when you see huge selling volume but price doesn't drop, that's absorption. Smart money is buying everything the public is selling. This is how bottoms form. When you see a stock rising on decreasing volume, that's a warning. The effort doesn't match the result. Eventually, gravity takes over. These three laws work together. Supply and demand determine direction. Cause and effect determine magnitude. Effort versus result reveal what's happening beneath the surface. But there's an invisible hand orchestrating all of this. Wyckoff called it the composite operator. Chapter 2, the composite operator and the market cycle. Let me shift how you see every market move. Imagine all the smart money in the market. All the hedge funds, institutions, market makers could somehow coordinate through shared understanding of market psychology. Now imagine this collective intelligence as a single entity. A master trader with unlimited resources, infinite patience, and complete understanding of crowd psychology. That's the composite operator. Here's the twist. The composite operator isn't real. It's a mental model, but once you view the market through this lens, everything changes. Every shakeout suddenly makes sense. Every false breakout has a purpose. Every stop hunt becomes predictable. Let me show you how the composite operator works. Phase 1, accumulation. The composite operator wants to build a large position. If they just placed massive buy orders, price would skyrocket. So they accumulate during fear and uncertainty. When retail traders panic and sell, institutional money quietly absorbs every share. They might even help create that fear, allowing price to drop more, triggering stop losses. This is why you see capitulation events at bottoms, that final flush lower that makes everyone throw in the towel. It's the composite operator, creating the optimal buying opportunity. Phase 2, markup. Once accumulated, they want price to rise, but not too fast. They manage the rise, creating higher lows and higher highs. Retail traders notice the trend. News becomes positive. Everyone gets comfortable, and that's when Phase 3 begins. Distribution. Now they have a massive appreciated position. If they dumped shares, price would crash. So they distribute during optimism and excitement. When retail traders buy enthusiastically, believing the stock will moon, institutional money quietly sells every share. This is why you see exhaustion events at tops. That final push higher that creates FOMO. It's the optimal selling opportunity. Phase 4, markdown. Once distributed, the composite operator no longer supports the stock. Buying pressure disappears. With only retail traders holding shares, price falls. Once you understand this cycle, you can position yourself alongside the composite operator instead of being their counterparty. Now, let me show you the detailed structure of these phases. Wyckoff identified 4 distinct phases that all markets move through, every single time. Phase A is where the previous trend halts. After a downtrend, Phase A is where selling exhausts itself. You'll see dramatic events, a selling climax where everyone who's going to panic sell has already sold. Massive volume, wide price swings. The composite operator is absorbing shares. After the climax comes an automatic rally. The selling pressure was so extreme that when it stops, price naturally bounces back. Then the secondary test. The market drifts back toward the selling climax low. If price can't make a new low on lighter volume, the selling is over. Supply is dried up. Phase B is where cause gets built. This is the longest, most frustrating phase. The stock meanders back and forth, testing the upper boundary, testing the lower boundary, going nowhere. Most traders hate this and abandon the stock for something more exciting. But this is exactly when the composite operator works hardest. Every test of lows is an opportunity to accumulate. Every failed rally shakes out impatient traders. The longer this phase lasts, the more cause is built. More cause means bigger eventual move. Phase C is the final test. After weeks or months of range-bound trading, the stock makes one final move that scares almost everyone out. Wyckoff called this the spring. The stock breaks below support. Stop losses trigger. Shorts pile on. Fear spreads. Then suddenly, the stock reverses and moves back into the range. That breakdown was fake, a trap designed to capture the last supply and shake out final weak hands before the real move begins. When you see a spring, it's one of the highest probability setups in existence. The composite operator just showed their hand. Phase D is where the trend begins. After the spring, everything changes. The stock makes higher lows. It breaks through the range with strength. Volume increases on rallies, decreases on pullbacks. These are signs of strength. The composite operator is no longer keeping price suppressed. They've finished accumulating. Now they want it higher. You'll see the last point of support, a final pullback before the major move. This is your last clear opportunity to enter alongside smart money. Phase E is the markup. This is where the public finally notices. Articles get written, analysts upgrade, momentum traders pile in, and the composite operator gradually distributes into all that enthusiasm. By understanding where you are in these phases, you can position yourself optimally. You don't buy in phase E when everyone's excited. You buy in phase C or early phase D when it still looks uncertain. Let me summarize before we dive deeper. You now understand the three laws. Supply and demand shows direction. Cause and effect shows magnitude. Effort versus result reveals truth beneath the surface. You've met the composite operator, a mental model for how institutional money operates. And you know the four phases. A stops the trend, B builds cause, C is the final test, D begins the trend, E is the markup. But here's something crucial. Seeing accumulation isn't enough. You need to wait for the right moment. Most traders identify a trading range and jump in immediately, then watch their capital sit dead for weeks while nothing happens. They give up, sell at break-even, frustrated. 2 weeks later, the stock explodes 40% higher. Their mistake was entering before technical readiness. They didn't wait for the spring or signs of strength. Patience in position, aggression in execution. Now let's dive into the specific patterns, the actual blueprint smart money follows. Chapter 3, Accumulation and Distribution. Schematics. There's something almost magical about seeing a Wyckoff schematic play out in real time. It's like watching a heist movie where you know the plan while everyone else is clueless. The accumulation schematic starts with preliminary support, the first sign that selling might be exhausted. Increased volume, wider spreads. But the stock stops making new lows easily. Then comes the selling climax. Maximum drama. Everything that could go wrong has gone wrong. News is terrible. Sentiment at rock bottom. Volume explodes. Price gaps down. Stops trigger everywhere. This is maximum pain and maximum opportunity. The selling climax isn't just random panic. It's the composite operator's final push to create the ultimate buying opportunity. On the other side of all that selling, they're buying, absorbing every share. After the climax, the automatic rally kicks in. When selling suddenly disappears, price bounces sharply. Shorts cover, bargain hunters appear. Then the secondary test arrives. Price drifts back toward the selling climax, low. If price returns to the low, but on much lighter volume, unable to make a new low, that's confirmation. The selling is exhausted. Smart money absorbed the supply. Now comes phase B, the long consolidation. The stock builds a trading range. Rallies, pulls back. Rallies again, pulls back again. Weeks pass, nothing exciting happens. But beneath the surface, each test of lows happens on progressively lighter volume. No supply left. Weak hands are gone. Only strong hands remain. Then phase C arrives with the spring. The stock has been trading in a range. Most traders have marked support and resistance. Some have stop losses just below support. Then one morning, the stock breaks down below support. Stops trigger. Shorts pile on. Fear returns. But if the breakdown happens on relatively light volume, if price doesn't collapse further, if the stock quickly reverses back above support, you just witnessed a spring. The composite operator shook the tree one final time. They trapped shorts. They triggered stops and absorbed those shares. The spring is often followed by the last point of support. The stock rallies, then pulls back one final time to the upper portion of the range. This pullback holds. Character has changed. Buyers are in control. Then the breakout. Phase D begins with a sign of strength. The stock breaks above the range on increasing volume, wide price spread. This is a statement. During phase D, each pullback finds support at progressively higher levels. These are your final opportunities to enter before major markup. Now, distribution mirrors accumulation, but the psychology is completely different. During accumulation, fear dominates. During distribution, greed dominates. It starts with preliminary supply. After a strong uptrend, you see subtle changes. Rallies aren't as effortless. Volume spikes on up days, but price doesn't move as much. Large volume with small price movement means someone is selling into buying pressure. Then comes the buying climax. The stock has been in a strong uptrend. Then one day, it gaps up. Volume explodes. Price makes a dramatic new high. Retail traders think, the breakout is happening. I need to buy. But the composite operator is selling into that enthusiasm. Every share an excited buyer purchases comes from an institutional seller. The buying climax is often marked by exhaustion. The price might make a new high intraday, but close near the low of the day. After the climax, the automatic reaction occurs. Buying exhausts itself, price pulls back sharply. Momentum traders who bought the high start to panic. Then the secondary test. The stock rallies back toward the buying climax high. If the stock can't make a new high, if volume is lighter, if the rally feels labored, you're witnessing distribution. Phase B of distribution develops a trading range. To most traders, this looks like healthy consolidation. Analysts might call it a bull flag. But underneath, something sinister happens. Every rally meets heavy supply. Every dip gets bought by retail traders who believe they're buying the dip. The transfer from strong hands to weak hands is nearly complete. Then Phase C, the upthrust after distribution. The stock breaks out above the range. Technical traders jump in. The move looks genuine. Then the stock reverses and falls back into the range. That breakout was fake, a trap to capture final demand before the markdown begins. After the failed upthrust, Phase D begins. Character completely changes. Lower highs, breaks below the range, signs of weakness. Down days on heavy volume with wide spreads. Up days on light volume with narrow ranges. The last point of supply appears, a final rally that fails. Your final opportunity to exit before markdown accelerates. Then Phase E, the markdown. The stock enters a downtrend. Support levels that held for months suddenly fail. Each bounce gets sold. And retail traders who bought during distribution, they're now trapped, watching unrealized gains turn into realized losses. This distribution schematic has played out at every major market top in history. The details vary. The time frame varies. But the psychology remains identical. Chapter 4. Volume Spread. Analysis reading the footprints. If price action is the surface of the ocean, volume is the current beneath. A trader who ignores volume will never consistently profit. Volume spread analysis is where Wyckoff becomes surgical precision, where you see what's really happening while everyone else just watches price bounce around. Here's the fundamental principle. Volume represents activity, the effort being made by buyers and sellers. But it's not volume in isolation that matters. It's the relationship between volume and price spread that tells the story. Imagine a marketplace. If there's a huge crowd but nobody's buying anything, interest is high but commitment is low. Now imagine a massive crowd frantically buying everything. Completely different story. The stock market works the same way. High volume on up bars with narrow spreads is a warning. All that effort produced little result. Someone is selling into buying pressure. This is how distribution happens in plain sight. High volume on down bars with narrow spreads is absorption. Smart money is buying everything being sold. The public is panicking, but institutional players are catching every falling knife. This is how accumulation happens in plain sight. Low volume on up bars can mean two things. Either the stock is rising effortlessly with no supply, bullish during a markup phase, or it's rising with no real demand, bearish during potential distribution. How do you tell the difference? Context. Where are you in the market cycle? After accumulation during an uptrend, low volume pullbacks are healthy. That's natural rhythm, no supply. But after a long uptrend during potential distribution, making new highs on declining volume is exhaustion, like a marathon runner stumbling across the finish line. Low volume on down bars during an uptrend is perfect. Pullbacks on no demand. Nobody wants to sell. Weak hands already exited. But during a downtrend, it means markdown is happening effortlessly. No buying support. Now, let me show you specific power patterns. No demand bar. An up bar that closes near its high but on very low volume. Appears during a potential top. The composite operator tested whether there's buying interest at elevated prices, and there isn't, usually followed by decline. No supply bar. A down bar that closes near its low but on very low volume. Appears during accumulation or after a spring. The composite operator tested whether there's selling left at depressed prices, and there isn't, usually followed by rally. Stopping volume. Massive spike in volume on a down bar during a downtrend, but price doesn't collapse further. In fact, the next bar might rally. This is professional absorption. Smart money just stepped in aggressively. Often marks important bottoms. Climactic volume. Extreme volume at turning points. A selling climax shows massive volume on a down bar with very wide spread, followed by immediate reversal. A buying climax shows massive volume on an up bar with exhaustion characteristics, followed by immediate reversal. These climaxes are emotional extremes, when the public completely capitulates or becomes irrationally exuberant. Exactly when the composite operator does their best work. Here's a pattern that will save you thousands. Up bars on widening spreads with increasing volume, followed by up bars on narrowing spreads with increasing volume. Initially, the stock rises with strength, good volume, good spread, good follow-through. Then character changes. Volume remains high or increases, but price isn't making progress. That's distribution. Smart money selling into strength. If you see this near the top of a trading range or after an extended uptrend, it's your signal to exit. The inverse works for bottoms. Panic selling with widening spreads, then narrowing spreads with increasing volume. Character changes. Volume remains high, but price stops dropping as much. That's accumulation. One misunderstood concept is initiative activity versus responsive activity. Initiative activity is when professionals are actively making things happen, accumulating aggressively, distributing aggressively, moving the market with purpose, high volume with strong price movement in their direction. Responsive activity is the market reacting to what professionals already did. Retail traders responding to news, stop losses triggering, breakout buyers chasing, high volume. But the quality is different. The follow-through isn't there. Volume spread. Analysis turns your charts into an X-ray machine. While other traders see green and red bars, you're seeing the transfer of shares from weak hands to strong hands. You're seeing preparation before major moves. You're seeing warning signs before trend changes. But you need a way to measure exactly how much cause has been built and project realistic price targets. That's where point and figure charting becomes essential. Chapter 5. Point and figure. Charting, measuring the move. There's something almost meditative about point and figure charting. While bar charts and candlesticks are noisy, point and figure charts are clean and purposeful. They strip away market noise and show you only what matters, significant price movement. Point and figure charts make accumulation and distribution patterns crystal clear, and they give you precise mathematical price targets based on cause. Unlike time-based charts where each bar represents a fixed time period, point and figure charts represent pure price movement. Time is irrelevant. Only price change matters. The chart consists of columns of X's and O's. X's represent rising prices. O's represent falling prices. You only record moves that exceed your chosen box size. For example, with a 1-point box size, price would need to move 1 full point to add another X or O. This filters out noise. When price reverses by a certain amount, typically 3 boxes, you move to a new column and switch from X's to O's or vice versa. This creates a visual representation of the supply and demand battle. When a stock is in accumulation, you'll see a tight cluster of X and O columns at relatively the same price level. The stock goes back and forth, testing support and resistance, but not breaking out. This is the visual representation of cause being built. The longer this congestion continues, the more columns you have, the more cause is created. More cause means bigger effect. The horizontal count method. You literally count the number of columns across the trading range. Each column represents market activity. The more columns, the more activity, the more shares changing hands. Here's an example. A stock trades in a range between $40 and $48. You're using a 1-point box size and 3-box reversal. Over several weeks, you count 30 columns of X's and O's within this range. To project the price objective, multiply the count by the box size, then add it to the base for upside target. 30 columns times 1 point equals 30 points of potential move. If accumulation is occurring and breakout will be upward, take the low of the range, $40, and add 30 points. Your price objective is $70. Does the stock always hit that exact target? No. Markets are probabilistic. But Wyckoff traders have observed for over 100 years that point-and-figure counts tend to be remarkably accurate. Think about why this works. The count measures how many shares changed hands during accumulation. It measures the intensity of the battle. A longer count means more activity, typically larger players building larger positions. When they eventually mark up the stock, they create enough movement to justify their effort. It's the law of cause and effect, quantified. Point-and-figure charts are also incredible for identifying quality of accumulation or distribution. High-quality accumulation has clean, orderly structure, consistent tests of support and resistance, symmetrical pattern, shows the composite operator working methodically. Low-quality or no accumulation has messy, erratic structure, wild swings, inconsistent patterns, might just be random volatility. These are charts you avoid. Let me share a pattern Wyckoff traders love. The fulcrum formation. This appears after a sustained downtrend. The point-and-figure chart shows a long column of O's as price declines. Then suddenly, the pattern compresses into a tight congestion area. Back and forth. X's and O's. This congestion at the bottom is the fulcrum, the pivot point, where trend is changing from down to up. It's accumulation at a major bottom. When you count the columns in this fulcrum and the stock eventually breaks out upward, the count often projects the entire next leg higher. The spring is visually obvious on point-and-figure charts. You'll see the congestion area maintaining a fairly consistent low, and then one column of O's pushes just below it before immediately reversing back. That's your spring. What box size should you use? This depends on stock price and your time frame. For expensive stocks, 2 to 3 point box size. For cheaper stocks, 50 cents or $1. Rule of thumb, your box size should be roughly 1 to 2% of stock price. This creates charts that aren't too sensitive or insensitive. For reversal amount, 3 boxes is the classic standard. This means price needs to move against the current column by 3 times your box size to warrant starting a new column. This prevents whipsaws. Here's a powerful combination. Use bar charts for visual clarity and pattern recognition. Use point-and-figure charts for counting cause and setting price objectives. Together, they give you both the story and the mathematics. When your bar chart shows a classic Wyckoff accumulation schematic, and your point-and-figure chart shows a clean count with a substantial price objective, you've got a high probability setup backed by quantitative analysis. That's the edge Wyckoff gives you. Not just art, not just science, both. Some Wyckoff traders multiply the horizontal count by average volume to get a volume-adjusted cause measurement. If massive volume occurred during the range, that's more cause. More shares changed hands. This provides even more precision. Once you've calculated potential effect, you can determine if the trade meets your risk-reward requirements before entering. If projected move is 10%, but stop placement risks 5%, that's 2 to 1 reward to risk. Might not be worth it. But if projected move is 40% and stop placement risks 5%, that's 8 to 1 reward to risk. Now, we're talking. The cause measurement allows you to be selective. You don't take every accumulation range. You take the ones with sufficient cause to justify the risk. Now you know how to measure cause and project targets with mathematical precision. But there's another dimension, trading ranges themselves, where all this cause gets built. Chapter 6, Trading Ranges Where Fortunes Are Built. The most important moves happen when nothing appears to be happening. While traders chase the hot stock of the day, real money is being made in stocks that look boring. Trading ranges, consolidation zones, sideways action. This is where the composite operator builds positions that will eventually generate massive moves. Not all trading ranges are created equal. Some ranges are genuine accumulation or distribution. Others are just pause points before the previous trend continues. And some are noise with no professional participation. How do you tell the difference? Duration, width, volume characteristics, and context. Duration. The longer a stock trades in a range, the more significant that range becomes. A 2-week consolidation might just be a brief rest. But a 3-month consolidation, that's likely accumulation or distribution. Think logically. The composite operator doesn't need 3 months to decide if they want a stock. If they're there for 3 months, they're working, accumulating without pushing price away, or distributing methodically. Time equals cause. The more time spent in the range, the more shares changing hands, the bigger the eventual move. Width. The width of the range tells you about the battle between supply and demand. A narrow range with tight bounds suggests one side is firmly in control, could be strong hands accumulated and holding. A wider range suggests more active combat. Buyers push it up, sellers push it down. Classic Phase B action where both sides are testing. Very narrow ranges after long consolidations can be dangerous. Might signal lack of interest. No volume, no volatility, no participation. But a range that maintains consistent width with healthy back and forth, that's cause being built. Volume characteristics within the range is where the story reveals itself. In genuine accumulation ranges, volume should be higher near the bottom, lower near the top. Makes sense. The composite operator is buying near support, absorbing supply. That creates volume. Near resistance, they're not selling, just letting natural rally pause. You should also see volume declining over time as the range matures. Early, there's still plenty of weak hands willing to sell. As accumulation progresses, supply dries up. Tests of support happen on lighter volume because there's nobody left who wants to sell. This is the spring being loaded. Less supply. Weak hands gone. Only strong hands remain. One final test with extremely light volume, then the breakout. Distribution ranges show opposite patterns. Volume is higher near the top, where the composite operator is selling into eager buyers. Volume near bottom is lighter because they're not buying. And volume often increases over time during distribution because the composite operator is actively working to unload their position. Context. Where does this trading range appear? After a major decline, likely accumulation. After a major advance, likely distribution. In the middle of a longer-term uptrend might just be consolidation before continuation. Context gives you bias. It tells you which interpretation is more probable. Now, let me show you a specific pattern Wyckoff traders watch obsessively. The creek. When the stock makes a series of lower lows within the range, almost like a downtrending channel within the sideways structure, it looks bearish, feels like breakdown. But then suddenly, after making these lower lows and likely triggering stops, the stock reverses sharply and rallies through the entire range. That creek was the spring manifesting as a series of tests, each slightly lower, shaking out every last weak hand. When you see a creek forming in a potential accumulation range, don't panic. That's likely the composite operator's final preparation before markup. There's also the inverse in distribution, terminal shakeout creek, where the stock makes a series of higher highs, looking bullish, before collapsing. That's the UTAD playing out across multiple tests. Quality of the range matters as much as its existence. A clean, orderly range with clear boundaries and logical tests is high-quality accumulation or distribution. The composite operator is working methodically. But a chaotic, whipsaw-filled range with constant false moves and unclear structure, that's low quality or no professional participation. Just noise. Avoid it. You want structure, clear tests of support that hold, clear tests of resistance that cap, volume patterns that make sense, price action that tells a coherent story. When structure is clean, your conviction can be high. When it's messy, your conviction should be low. Now, let's talk about breakouts from trading ranges, because this is where most retail traders get trapped and where Wyckoff traders make their money. Retail traders see a breakout above resistance and think, the move is starting, I need to buy. So they buy the breakout with stops just below resistance. Either the breakout is false and they get stopped out, or the breakout is real, but they bought at the beginning and had to endure a pullback. Wyckoff traders do it differently. They enter before or during the spring, when the stock looks weakest. Or they wait for the breakout, let early enthusiasm play out, then enter on the first pullback to the last point of support. This gives better risk-reward and higher probability. You're entering when others are uncertain, not when everyone is excited. Here's the pattern. The stock breaks out of accumulation range on sign of strength. Volume increases, price spread widens, momentum is strong. Retail traders buy here. Then the stock pulls back to test the top of previous range, now support. This pullback happens on light volume. No selling pressure. This is the last point of support. That pullback is your entry. You're buying at support with a clear stop below the range and with breakout already confirmed. Risk-reward is optimal. Real-world analogy. Imagine trying to board a train that's leaving. You can try to jump on while it's accelerating out of the station, dangerous and awkward. Or you can run alongside as it slows briefly and step on smoothly. The The last point of support is like the train slowing momentarily, your smooth entry point. Once you've calculated potential effect using point and figure counts, you can determine if the trade meets your risk-reward requirements before entering. If projected move is 10%, but stop placement risks 5%, that's 2 to 1, might not be worth it. But if projected move is 40% and stop placement risks 5%, that's 8 to 1. Now we're talking. The cause measurement allows you to be selective. You don't take every accumulation range. You take ones with sufficient cause to justify the risk. Trading ranges are where the silent transfer of wealth occurs, from weak hands to strong hands, from the impatient to the patient, from those who don't understand to those who do. When you see a stock in a 3-month trading range and most traders have moved on, remember this. The composite operator hasn't moved on. They're working, accumulating or distributing, preparing for the next major move. And when that move happens, they'll profit from everyone who wasn't paying attention. But you'll be positioned alongside them, because you understood what was happening when it looked like nothing was happening. Before we move to practical application, let's recap. You now understand accumulation schematics. Selling climax, automatic rally, secondary test. Phase B, consolidation, spring, last point of support, sign of strength. And distribution schematics. Buying climax, automatic reaction, secondary test. Phase B, consolidation, UTAD, last point of supply, sign of weakness. You've learned volume spread analysis, the relationship between effort and result that reveals what's happening beneath the surface. High volume with narrow spreads shows absorption or distribution. Low volume on pullbacks shows lack of supply or demand. You understand point and figure charting, how to count cause and project mathematical price targets. The horizontal count method gives you quantitative precision. And you've decoded trading ranges, where all this cause gets built. Duration, width, volume characteristics, and context tell you whether a range is genuine accumulation, distribution, or just noise. Now think about this. Have you ever watched a stock consolidate for months, got bored, moved on, and then saw that same stock explode 30 or 40% higher a few weeks later? That's not bad timing. That's not understanding what Phase B accumulation looks like. That's exiting right before the spring or sign of strength because you didn't have the patience. The Wyckoff methodology gives you that patience because now you understand what's happening during those boring consolidation periods. You're watching the composite operator work. You're counting the cause. You're waiting for the spring. And when everyone else has given up and moved on, you're positioned for the move that rewards patience. Now let's talk about how to systematically find these setups and apply everything you've learned. Chapter 7. Practical Application, Finding and Trading Setups. Knowledge without application is just entertainment. Let me give you a practical framework for scanning markets and selecting the best Wyckoff setups. You're not looking for every opportunity. You're looking for optimal opportunities where multiple factors align. Quality over quantity. Here's the systematic process. Step 1. Determine the market environment. Before analyzing any individual stock, know where the overall market is in its cycle. Are the major indices in accumulation, markup, distribution, markdown? Pull up a chart of the S&P 500. Look at the larger time frame, daily or weekly. Apply what you know about phases and schematics. Where are we? If the market is in accumulation or early markup, you have a green light for longs. If the market is in distribution or markdown, you're cautious. Maybe focus on shorts or wait on sidelines. Trading against the major market trend is possible, but requires exceptional setups. When starting with Wyckoff, trade with the market. Step 2. Create a watch list of stocks showing relative strength. Use a stock screener to filter for stocks that outperformed the market over the last 3 to 6 months. You're looking for stocks that rose more during rallies and fell less during pullbacks. Why relative strength? It indicates professional interest. When smart money accumulates a stock, they support it. It doesn't collapse when the market gets volatile. Your watch list should have 20 to 50 stocks, enough to provide opportunities, but not so many you can't pay attention. Step 3. Analyze each watch list stock for Wyckoff setups. Apply your knowledge of accumulation schematics, trading ranges, and phase analysis. You're looking for stocks, building cause, or showing signs of strength after accumulation. Go through each chart and ask, is there a clear trading range? How long has it been consolidating? What's the width? What do volume patterns look like? Have there been tests of support on declining volume? Is a spring potentially forming or already completed? You're looking for setups in progress, not setups that already played out. A stock that broke out 3 weeks ago and moved 30%, that's not your setup. You want stocks in phase C or early phase D. Step 4. Apply the 9 tests to your best candidates. You've narrowed to maybe 5 or 10 strong candidates. Now, apply the rigorous checklist. Market position and trend. What is the present position and trend of the market? Relative strength. What is the stock's trend, and how does it compare to the market? Sympathy. Is the stock moving in sympathy with or against the market? Responsiveness to supply and demand. How responsive is the stock? Cause built. What is the cause built, and what is the potential effect? Point and figure indication. What does the point and figure chart indicate? Wave position. What is the position of the stock on the wave chart? Support and resistance levels. What are the important levels? Technical readiness. Is the stock technically ready to move? Be honest and strict. If a stock fails even one test significantly, move on. The best trades pass all 9 tests convincingly. Step 5. Prioritize based on risk-reward and cause measurement. You might have 2 or 3 stocks that pass all 9 tests. Now, rank them. Which has the largest cause, best projected risk-reward, cleanest schematic? Your capital is limited. Focus on the best of the best. Step 6. Determine your entry strategy. For each setup, decide exactly how you'll enter. Will you enter on a spring, wait for the breakout and last point of support? Enter during phase D on signs of strength? Entering on the spring offers the best risk-reward, but requires nerves of steel. Entering on last point of support offers confirmation and good risk-reward. Entering on signs of strength offers most confirmation but slightly worse entry prices. Choose your approach and stick to it. Step 7. Set your stop loss and position size before entering. This is non-negotiable. Know exactly where you're wrong and how much you're risking. For accumulation trades, your stop typically goes just below the spring low, or just below the bottom of the trading range. You're wrong if the stock breaks down below accumulation. Your position size should be calculated so that if your stop hits, you lose only 1 to 2% of your account. Even great setups fail sometimes. You need to survive to trade another day. Step 8. Monitor the trade and follow your plan. Once you're in, the hardest part begins. Doing nothing. If you picked a good setup and entered properly, the stock should start moving in your favor soon. Don't micromanage. Don't panic on normal volatility. Trust your analysis. Your stop protects you if you're wrong, but pay attention to character changes. If volume patterns shift, if the stock shows signs of weakness, if it breaks below last points of support, those are warnings. Common mistakes traders make even when they know Wyckoff methodology. Mistake 1. Entering too early. They identify accumulation in phase B and enter immediately, then watch their capital sit dead for weeks. Be patient. Wait for phase D and technical readiness. Mistake 2. Ignoring market environment. They find a perfect accumulation schematic, but the overall market is in distribution. Then they wonder why their stock can't rally. You can't fight the macro tide. Mistake 3. Poor risk management. They risk 5 or 10% on a single trade because they're convinced it will work. Then when it fails, they're decimated. Risk small, always. Mistake 4. Not using the 9 tests rigorously. They see a pretty chart and convince themselves it's accumulation, but if they honestly applied the tests, it would fail several. Use the checklist. Mistake 5. Chasing after the move started. They hesitate during phase C and early phase D, then finally FOMO in during late phase D or phase E. They end up buying near distribution. Patience and discipline are everything. Wyckoff principles apply to all time frames. For swing trading on daily charts, you're looking for ranges that lasted weeks to months. For day trading on intraday charts, ranges that lasted hours. The structure is the same, just compressed. For longer-term position trading on weekly charts, ranges that lasted months to years. These massive bases lead to massive moves. Match your time frame to your lifestyle. If you can't watch screens all day, don't day trade. Focus on daily or weekly charts where you can make decisions once a day or once a week. Keep a trade journal specifically for Wyckoff setups. For each trade, screenshot the chart showing accumulation range, your point and figure count, your 9 test checklist, your entry and stop. After the trade concludes, review it. This reflective practice accelerates your learning exponentially. You develop intuition. You get better at distinguishing high-quality setups from marginal ones. Markets evolve. Volatility changes, behavior shifts. But the underlying psychology, fear, greed, hope, panic, that never changes. And as long as human psychology drives markets, Wyckoff's methodology will work. You now have the complete framework, the 3 laws, the composite operator and market phases, the schematics of accumulation and distribution, the tools of volume spread analysis, point and figure counting, and trading range analysis, and the practical application. This is your edge. This separates you from the crowd trading on hope and fear. You're trading on structure, psychology, and probability. But knowledge is just the beginning. Now comes the work of applying it consistently, day after day, trade after trade, until it becomes second nature. Can you feel it? That shift in how you see the market? Right now, you know something 99% of traders will never understand. You know that every chart tells a story, that price and volume leave footprints, that the composite operator is real, not as a person, but as a force. And those footprints, you're learning to read them. Think about what we've uncovered. We started with a 15-year-old boy running stock certificates through Wall Street and discovered a methodology that stood the test of over 100 years. We learned the 3 fundamental laws: supply and demand, showing direction; cause and effect, showing magnitude; effort versus result, showing what's beneath the surface. We saw how the composite operator thinks, how they accumulate in fear and distribute in greed, how they shake out weak hands and trap breakout traders. We walked through the 4 phases. A stops the trend, B builds cause, C is the final test, D begins the trend, E is the markup. We examined the schematics, the selling climax and spring, the buying climax and upthrust, signs of strength and signs of weakness. We decoded volume spread analysis, point and figure charting, trading ranges, and created a systematic process for finding and executing trades. But here's the question. What are you going to do with this? Are you going to go back to trading the same way? Chasing breakouts without understanding if they're genuine or traps? Buying dips without knowing if accumulation or distribution is occurring? Or are you going to start applying the Wyckoff methodology, studying charts through this framework, training your eye to spot springs and upthrusts? The market will continue doing exactly what it's always done. The cycle will repeat. Accumulation, markup, distribution, markdown, over and over. The only question is which side of the trade you'll be on. Will you be buying the buying climax or positioned alongside the composite operator? Will you get stopped out on the spring or recognize it as the final shakeout? Your edge isn't in having better indicators. Your edge is understanding market structure and positioning where probability is highest. Now, I want to hear from you, and this is important. Choose one stock you're currently watching. Over the next week, analyze it through the Wyckoff framework. Identify which phase it's in. If it's in a range, count the cause. Watch for footprints in volume and price action. Then come back and comment your full analysis. Include the ticker, the phase you identified, your cause count if applicable, and what you're watching for next. I'll personally review the first 50 comments and give you real feedback on your analysis. Not just a thumbs up, real feedback. This is how you cement this knowledge. Not by passively watching, but by actively doing. By applying the framework to real charts. Because knowledge without application is just entertainment. The market has always been a transfer of wealth from the impatient to the patient, from the reactive to the strategic, from those who don't understand to those who do. Richard Wyckoff spent his career teaching regular people how to read smart money's footprints. He gave away the playbook Wall Street wanted to keep secret, and now you have it too. The question is, will you use it? If this video transformed how you see the market, subscribe to Trading Psychology Stick. We're going deep on market psychology and methodologies that actually work. I'll see you in the next video. Until then, start looking at every chart through Wyckoff's eyes. You'll be amazed at what you start seeing.